Good afternoon, good evening, and early good morning. So this is really depending on where you are. I'm Jun Yang. I'm the director of Kelley's Institute for Corporate Governance. So we have been existed since 2004, and the mission for the Institute is really to promote research on corporate governance related issues and to inform policymakers and to change or influence organizational practice. So we have launched this series of public lectures on corporate governance in November 2021. Today we are on number 20 of this whole series. So we tackle classic questions like corporate board, CEO compensation, insider trading, and so on. We also present challenges that brought in by a new environment and new technologies such as climate risk and data and security. So the series has been hosted by European Corporate Governance Institute, ECGI, and I use Ostrom Workshop. So in our series, we have several lectures that cover ESG, environmental, social, and governance related issues. Our inaugural lecture given by Alex Edmond in November 2021 has the title ESG, Do We Need It and Does It Work? If you know Alex, you know the answer is yes. And Laura Starks from Texas covered climate risk and institutional investors in March of this year. And a marketing professor, Professor Paharia, covered the ethics of consumer choice back in May. And today, this is well-needed, overdue lecture on greenwashing, ESG investing at a crossroads. Given that we've been doing ESG-related research for so many years, and there are hundreds of research papers on this topic, should we look back to examine, do they could be corporations, could be fund managers or asset owners, do they walk the walk or do they only talk the talk? Forthcoming, we're going to have rating agencies. So on February 1st, Jess Cornelgia is going to talk about certification agents, including ESG rating agencies. And in March, Carolyn Flammer is going to talk about ESG with system level investing. So all our public lectures are hosted in the ICG blog series. The address is listed below. So the next lecture is on the governance of certification agents on February 1st by Jess Cornelgia. Please take out your device. This is the QR code, so you can put it in your system. I'm going to stop here briefly. All right, I'm going to introduce today's moderator. Actually, Jenny and I are in the same room upstairs of NBER's 1050 Massachusetts Avenue. It's a tiny room. We may look at each other from time to time. Jenny was my colleague at Indiana for 6 years. She is associate professor of finance at Georgetown University's McDowell School of Business. I know I butchered it. Janet research focused on area of empirical finance with many areas. She started from financial intermediation. She does labor and finance, from supply chain relationship, and she does more and more of the ESG on the S side, on the E side, as well as the G side. Janet research has been published in many top academic journals like JFE, RFS, Management Science, Review of Finance, JAE, and Accounting Review. Janet is associate editor at Review of Financial Studies and Journal of Financial Intermediation. She has helped the American Finance Association in mentor young scholars, young women scholars. She had made substantial contribution in that area. She graduated from Peking University for her bachelor degree, and her PhD is from Cornell University. Now I'm going to pass this to Janet to introduce our speaker for today.
Thank you so much, Jim, for giving me this honor to introduce Pedro. So let me just start by the regular process. Professor Pedro Matos is a chair professor of business administration at Darden School of Business, University of Virginia. He's also a research associate at the European Corporate Governance Institute and the academic director of the Richard A. Mail Center for Asset Management. As you can see, he's a very busy person. And this is because he's such a productive, prolific researcher in the area of corporate finance. He has over 20 top journal publications and over 13,000 citations. As we all know, this is an incredible achievement, and many of us will look up to that. So in terms of his research area, broadly, his research would belong to the areas of asset management, investments, corporate governance, and international finance as well. But in terms of specific topics, he covers, he's an expert on the role of institutional investors, but also branches out in many other important areas, such as banking, the labor market of CEOs, M&As, and so on. I remember reading Pedro's work when I was a PhD student and always felt quite inspired by many of these good ideas. And in recent years, Pedro has been devoting more attention to ESG-related topics, including the effectiveness of sustainability investment and the role of responsible investors. And in today's talk, he's going to discuss this really important and ongoing issue, given the current trend and also controversy regarding sustainability investments, given that there has been more and more pushback in different parts of the country as well as over the world. How do firms and managers respond to it? What should the investors expect? These are all very important, relevant topics, and I'm very much looking forward to it. So now I'm going to hand the floor to Professor Matos and start his talk. You have the floor.
Great. Thanks, Janet. Can you guys see my slides? Okay. Well, thanks again so much for the invitation. Very pleased to be here and talk to you about ESG. ESG has been in the news over the last few years a lot. So you think back like even 3 years ago, ESG was, or 2021 was labeled the year of the ESG. You had record flows into these funds, ESG stocks outperforming, activism with firms like Exxon, regulations from the EU, etc. To like 2022, when these things were starting to break apart a little bit. This is a cover of The Economist 3 letters that won't save the planet. That was the subtitle. Whistleblowers accusing the industry of greenwashing, becoming more skeptical. And The Economist was saying it's best to focus on E, so to line up these private ESG initiatives on climate change with government action. To like what we're seeing just this week, which is headlines this week in the Financial Times, talking about the slowdown and outflows of ESG. Is this just a market correction? Are we after overdoing it? Or are we seeing more regulatory scrutiny? This is political backlash, as Jenna just pointed out. So the Wall Street Journal, for example, says it's actually been a bad year for clean investments, and many evidence around greenium sort of going out. But this is not just this two, it's very pervasive around many press outlets. So very good time to look into this, to the ESG theme. But also another reason to look into this is this week, we're undergoing the COP28, the Climate Action Summit in Dubai. And there are some reasons to be pessimistic about what progress have we actually made. So this UNEP emission gaps report, that's subtitled Broken Record, finds that the world is heading for temperature rise far above the Paris Agreement. And I don't know if you guys can see a small dip that existed during the lockdowns in 2020, but it's come back. As things stand, government commitments will still leave us within 2.5 to 3 degrees above pre-industrial levels. That's higher than the 1.5 degrees centigrade that the Paris Accord asks for. Again, reasons to be optimist would be for example, Wall Street Journal, which wasn't so optimistic on as I just showed you, there's been really costs for renewables have plummeted and the growth is exceeding expectations. So the IAE, the International Energy Agency, has underestimated the growth of some of these things like, renewables. You can see for solar, for wind, for electrical vehicles. Alongside renewables, you need storage because this might be intermittent. And coal is also being eroding. And for storage, you're also seeing improvements in terms of the cost of this, storage technologies. And finally, many markets, the cost of switching from small, mid-size EV from a gasoline powered vehicle. It's already occurred in places like China. It's occurring in Europe as we speak, and we might get to that point in the US. So there's a lot reasons to be half empty and half full. So it's really very good time to talk about this, as I said. This colors here it's very elegant way to represent the long-term temperature trends. They're called the warning stripes, sorry. And we're seeing a large spectrum of opinions also around this. So you could look at this as new data, right? This temperature rise, new risks and opportunities. And if we just, like the cartoon suggests, we just threaten our existence, a lot of people may be, disengaged from that. But if we bring up that this could threaten our investments, a lot of investors may tune in and think, well, maybe we need some new investment styles or new methodologies, new risk management systems to deal with this. That's fairly neutral, but some might go a step further and call this a philosophy or ideology. And I don't know so if you see this Twitter feed from Elon Musk saying that ESG is a scam because Tesla's been cut from S&P ESG index. So some would even say this might be nonsense. So the big thing I think I really want to focus on is this concern around greenwashing. So there's some definitions here about what greenwashing. You can also have blue washing and rainbow washing and other, not just on the environmental dimension, but sort of making false claims or misleading statements around the sustainability profile of financial products or service. And this can erode the trust on ESG investing. And the reason I did say we had 3 years was last year, 2022, we had a number of scandals. So in Europe, you had formerly Deutsche Asset Management, the DWS group, being investigated by the German regulator. Whether they were greenwashing, incorporating or not ESG factors into their products. The police raided their offices, the chief resigned, and they were levied heavy fees. And in the US as well, you had SEC investigations around greenwashing at BNY Mellon. I actually took this picture at the day that the news came out. And if you went on BNY Mellon at the day of the news, they had actually, seeing through greenwashing on their own website, like they were advocating that people should be concerned about greenwashing when they were themselves being accused of greenwashing. And Goldman's also has been levied some penalties on this. So here's my outline. I'll talk about some of background on ESG investing that's informed by a literature review I wrote for the CFA Institute, and talk about a first paper, some evidence that not all ESG investors may be walking the talk, particularly in the US, and this suggests some greenwashing. The main reason being there might be conflicts between these commitments and their fiduciary duties. And then talk about whether, even if you do walk the ESG talk, which is what we document for mostly European investors, that may not result in real impacts. And we'll look at that within the context of climate change, and finish up with some takeaways. And let's see how much I can do this as I flip through quickly some PowerPoint slides. So some just some disclaimers are, this is very messy, and hopefully I think all this scrutiny is just healthy dose of skepticism. And my goal here is that we sharpen the focus and really advance this. It is some caveats here is that I will focus more on my own journey, and I do want to thank all my co-authors on this journey. But there are a lot more papers out there that I'll cite, some more good surveys, including Laura Stark's presidential address last year, which I highly recommend. But also, as June pointed out, a number of the series that Kelley, ICG, and ECGI is running on this webinar series. I would warn you that even I'm not a climate scientist and so many others, so we all are somewhat subject to this competency greenwashing. Like, I don't want to overclaim our findings here, but the best way I think to suggest that is to read through what Alex Edmonds has in his Twitter feed, which is, if you focus on a particular story, it may not be true. If you bring up a fact that is not data, that fact needs to be representative. Data may not be evidence because it may not, and evidence may not be proof because it may not be universal. So, and even if you documented causation in one setting, that doesn't mean it applies in every other setting. So I would just always warn us to take every study in context and not overclaim. So what is ESG? I think most people are familiar with this, but it's increasingly assessing portfolios based on non-financial data or investments broadly on environmental impact, like carbon emissions, pollution, resource use, on social concerns like firm relations with workforce, customers, and communities on G. Those are more traditional topics in corporate finance. How aligned is the company with the interests of shareholders? How independent is the board, managing incentives, etc. So we can think about SRI, ESG, all those reduction of these risks and leveraging private capital address these concerns that are coined as sustainable development goals. You see those boxes down there. And who's driving the focus? As I mentioned, some investors like BlackRock coming out in January 2020 with a letter by Larry Fink saying that this is a fundamental reshaping of finance, State Street, Vanguard, but also corporations talking about ESG, pre-pandemic, the statement that came out on the purpose of a corporation that would put out, value to customers, employees, suppliers, communities before shareholder value. Actually, the Council of Institutional Investors pushed back on some of that. So I will just say, there's been many high-profile scandals over the last 20 years. You can remember Enron, BP, Horizon, oil spill, the VW Dieselgate, and Facebook's data privacy breach. And also, of course, you have more over this last couple of years with the pandemic. So I think it's reasonable. And officially, it's been coined in 2004 with the publication of the UN Global Compact's Who Cares Wins report, the three-letter ESG. But this chart from the UN's PRI, Principles for Responsible Investment, gives a history going back to ethical investment by Quakers, other religions and denominations, all the way going back to SRI efforts to end the apartheid in the 1980s, to the launch of the PRI, as I mentioned, subsequently in 2006. And then the Paris Accord of 2015 and a lot of the initiatives that came out of that, like Climate Action 100 and the COP26. So 2 COPs ago, you had the global Glasgow Financial Alliance for Net Zero. What's driving ESG? Financial materialities, like the relationship that this ESG issues could hurt performance. So some clients may be driven by the potential to control the risks of this ESG being material or enhancing returns. That there's a high debate over whether that can happen or not, or whether that can be only transitory. Some other clients may have broader social values, goals, and this is a classification that Laura Starks talks about it in her presidential address. So I highly recommend going back to that. And they might be, shifts in social landscapes or evolving investor preferences that are pushing, for these values to be reflected in investments. The big word here is really that there's a lot of policy and regulation coming out, and I'll talk about this later: disclosure, stewardship codes, taxonomies. But the big word here is in the US is this concern around fiduciary duties. What is that? Ensuring that those that managing other people's money do so with appropriate care, skill, and loyalty in the interest of the clients or the beneficiaries, and consider ESG issues not in that course. Now, this is crazy, but this was the first President Biden's veto during his years, was when the GOP-led anti-ESG legislation was coming out, and he wanted to defend the Department of Labor understanding on ESG being allowed into the RISA plans consideration. So this has risen up to become political as well. Ultimately, as I said, we do care about whether all these efforts are managing to deliver on the Sustainable Development Goals or the Paris alignment. And I will talk a lot about the PRI, so this initiatives around these principles. One issue I always have a concern is it really depends how you look to figure out how big is ESG. Like a lot of academic studies truly just focus on mutual funds in the US. And there's a lot of overclaim, I think, by those academic studies, because that is actually the smallest drop in ESG money. It is only $300 billion in the US. Now it's several, $100 billion, but it's in the realm of capital markets, that's not a big number. So that dark green on this picture, that's the cumulative on the left AUM, and that's only 300 billion in the US. The large majority actually resides in Europe, and that's more like close to 2 trillion. Now, it is true that ESG funds have been more resilient, whereas in the US, there's actually been some outflows. But the outflows in the US are, 2 or 3 billion per year. It's not, or quarter, it's not really that big. And it is true some are removing ESG-related terms in the US, but not in Europe. So that would be a very narrow, even if you combine European assets, that's only 2 trillion. You could take a wider lens, and this is the GSIA, Global Sustainable Investment Alliance, and they have a much bigger number, like 30 trillion, and that is actually shrinking from 35 trillion. This number just came out a few days ago, and their last report 2 years ago had been higher. So it's interesting because there's a lot of been some pushback and some reclassifications bringing this down. Okay, the wider, and I've been told to slow down by some of the members, so I will do that. The wider lens is this PRI. The PRI is this principles I'll focus on next, and they can talk about over 4,000 signatories, 5,000 I believe right now, and over 100 trillion in assets. So depending how you define ESG and what incorporation of ESG, you can get different numbers and can reach different conclusions at what is the impact of this ESG. So I was very interested in the topic myself, as I said, and I started working on this first with a survey, and then 2 joint projects with co-authors in Geneva, Raina Gibson and Philip Kruger, Tom Steffen, and also postdocs here at the Mayo Center at the University of Virginia Darden School, Simon Glossner, who's now joined the Federal Reserve Board, and Vaska Atadarkwa, who's just about to finish her postdoc here. And I was really interested in how much is there really, what is the extent of ESG adoption? So let's go more slowly now. So I decided to take a look at the PRI, and what is the PRI is this initiative, and this is the picture when it was launched, to leverage the private sector to, come alongside government efforts. And this was launched by the United Nations, knowing that our commitments to sustainable development goals were not being achieved just through government action. And so the idea is that the signatories sign up to these principles. The first one is that they will incorporate ESG issues into investment analysis. Number two, they'll be active owners. And number three, they will seek disclosure, ... More importantly, that they will report, principle number 6, they will report their activities and progress implementing this principle. So that's where I will be privileged enough alongside my co-authors to first look into this data. Now, I showed you the growth curve before, the exponential growth in this initiative. It's become the most influential organization in this space. A lot of the signatories tend to be concentrated in Europe, but there's also big pockets here in North America, Asia Pacific, LATAM, etc. Some of the, you'll recognize some of these names. This data is from the 2019, so pre-pandemic assessment report data. They did change the methodologies a little bit, but they are more recent data from the PI every year. And so you'll see that a lot of them are, in number, a lot of them from Europe, and a lot of the assets that they report on are equities and fixed income. Now, I'll focus more on equities because we have more data on that. But if you read through my CFA literature review, you'll also see some statistics for fixed income. So how does this PI signatories implement that principle number 1 of incorporating ESG into their investments? This is a taxonomy that the PI, the GSIA, which I mentioned before, or the CFA Institute have sort of gravitated towards, which is you have to make a decision when you buy a security or a decision when you sell a security. So let's start from the end. That sell decision would be a divestment decision. Therefore, you're not doing ESG investing with that security anymore, right? But if you're doing a buy decision, you can negatively screen. That's very pervasive, as I will show you. Certain sectors, companies, or practices. You can choose best in class, or you can use some norms-based investing, or have a dedicated strategy which is called thematic investing, just on clean energy, green technologies, sustainable agriculture, water, etc. Integration, where you incorporate everything into all these factors into the financial analysis, so you don't exclude anything or focus on anything, but for every investment you make, every risk management decision or monitoring you do, you integrate ESG. Or finally, engagement, which is the idea that you are going to try to change the ESG practices of the companies that you're invested with, individually through engaging with those companies, filing shareholder proposals, collaboratively through initiatives like the PI collaborative platform, or internal voting, which is like your decision to vote and not outsourcing that, for example, to a service provider. So what do we find? We find negative screening is the most popular, the purple colored there. The thematic is still niche, and a large fraction are reporting integration and engagement, but it's very murky what that really means, right? Now, this is what economists would call the extensive margin, who reports that they do. But if you look at the intensive margin, which is how much of the AUM do you actually deploy these techniques, Europeans tend to do a lot more than, on screening, for example. Thematic is niche, as I mentioned, and there's some more disclosed or reported integration. Engagement, there's no data there on the intensive margin. So with that, I'll turn to the more detailed study that I did with some co-authors here at UVA and the University of Geneva, which is whether the signatories of the PI that are reporting this level of incorporation, ESG incorporation, what is it that they do in terms of their actual portfolios, and is there or not a disconnect between what they report and what they do? Now, we would not be the first study, but I'll leave you with some references here if you want to go back. But this is the first where we were mapping these two things, the reports to PRI and their portfolio data. So here's the report, for example, for BlackRock. They joined they signed this in 2008, and this is a report, for example, for a given year, and there are different modules here. We focus mostly on the direct listed equity incorporation, this part here, and for example, only on those indicators that are mandatory to report and disclose. One big one is the one I showed you before, is what is the percentage of the equity portfolio that you apply ESG? And the answer to that for BlackRock is that 61% of the AUM does not incorporate ESG. Only 30% does integration. This is our small numbers on your screen. I apologize. 4% would be screening, for example, but the majority of the assets they report are not taking into account ESG. And mind you, they do a lot of, they have iShares, a lot of passive products, etc. as well. There's a different module also for passive incorporation, but then BlackRock answers get compared with other signatories, and they get a score actually. How are they doing in different things? In listed equities, for example, they get A+. They might not score so well in fixed income, etc. And they voluntarily display this score in their website. This is not mandatory to, but this data is, at its prime 2-3 years ago, everyone was trying to report good scores in terms of ESG incorporation on their websites. So we look at the PI survey. That's data set number 1, I showed you before. Then we combine that, map that to equity portfolio holdings around the world. This is some work I've been working with Miguel Ferreira and many other co-authors over the year from FactSet. With institutional holdings around the world. So we might have Allianz Bernstein, then they might hold, let's say, Volkswagen, Novartis, and Exxon. And then the third data set we combine is 3 leading raters, ESG raters, MSCI, Refinitiv, and Sustainalytics, to compute a portfolio ESG score. In other words, how are the stocks sustainable as measured by a consensus of these 3 raters? Although we did do independent studies for each of them, the results were fairly consistent. So what we see, a growth in PI signatories. I was showing this picture before. In blue would be the non-signatories, institutional investors. In green are the signatories. In number, they've grown to several hundred, 600, I believe, and then growth in AUM, 60% of the assets. They're super large investors like the BlackRocks of the world that are more than 1 in every $2 is now a signatory of this initiative. The growth was faster outside the US, and now it's very pervasive, 75% at the end of our study, and 50% still in the US. But these numbers have grown since the end of our study. So that first question was, are the signatories walking the talk or not? Do they exhibit better portfolio footprints than the non-signatories? And outside the US, the top panel here on this table shows you that yes, they do walk the ESG talks in terms of incorporating. But interestingly, on the bottom panel, sorry, the other way, on the bottom panel, the non-US, there is a positive loading, or if you look at the curve on the right, the signatories in green are to the right of the non-signatories. But interestingly, in the US, the top panel, I should say, there is actually a negative coefficient, which, if anything, suggests that they actually have worse scores than those that don't. So why is it that they have less worse ESG scores? And is there a concern around, greenwashing? So we wanted to go into this, but we wanted to leverage also the data I showed you around what level they were reporting, were they screening, were they thematic, were they doing integration. So we look at what's that first part of incorporation, although we conducted some tests around engagement where we didn't find much evidence there. We are mostly focused on the first part of the asset allocation decisions. And on that, the US signatories, that bad result of the US signatories having US lower ESG scores, that is concentrated on a lot of signatories that actually don't even report any any level of incorporation. And that is why we might be inclined to label this as evidence of some greenwashing, because they join this initiative, they don't even report any incorporation, and they tend to have worse scores. Whereas in outside the US, those that report partial or full incorporation, full being 100% of the assets have one of those screening, integration, or thematic, then they are more aligned. That is, their scores tend to be higher than their portfolios allocations tend to be more sustainable. Okay, and so a big question for this study that this study leaves us with is, why is there this difference between the US and the rest of the world? And the commercial motives in the US would be, one reason we document in the study is that US institutions are rewarded by particularly retail flows, by retail clients after they join the PRI. Now, institutional investors, institutional clients, I should say, they do a lot more due diligence, and they actually don't just get, let's say, fooled by joining the PI. But at the early stages of this, we do find a bump in fund flows after institutions join the PI. And this is particularly true after they recently underperform. So if they're struggling with performance, one way, and there's a lot of competition these days with passive and indexing, one way active managers can kind of bump their assets would be to join this initiatives like the PI. That's one reason. The second reason is this big debate around the fiduciary duty that I just mentioned before. During the last year of the Obama administration, the DOL introduced the ruling saying that you could incorporate ESG considerations, but then in the Trump administration, that got reversed in 2018. And with Biden, it just got added back in. And then Biden, the Congress was trying to, rule that back, and then Biden had to veto. So all this regulatory uncertainty, I think, exposes a lot of investors to some potential litigation risk, or that may therefore limit their incorporation of ESG. And the way we tested for this is we actually used a shock that occurred in the UK, where prior to 2014, the UK was not allowing as well ESG incorporation, and then they clarified it, and we subsequent to that, the PI signatories started more walking the talk. So this predates the discussion here, but that was like a definitive task that we did there. And then finally, and there's a lot of similarities in the common law environment in the UK and the common law environment in the US. So maybe the evidence from the UK can somewhat speak to what's might happen here if we get more clarity in the US. And lastly is also the US is a little bit behind, as I showed you. The AUM by the PR signatories is increasing, but it's increasing faster in other markets compared to the US. And so there's more peer pressure in the other markets to walk the talk versus markets like the US, where there's been still lower penetration. So first study conclusions is in the US, there's a large disconnect between commitments and portfolio outcomes. And this is maybe consistent with greenwashing. Outside the US, words and actions are more aligned, and we observe better footprints for the signatories that incorporate fully or partially ESG. But I think, again, there should be more research examining these differences across the the geography. Now, the funny thing about this, the paper is published now in the Review of Finance, and then was featured after it came out in the special issue of their RF. It was featured in The Economist magazine, and the subtitle there was "Dubious Green Funds Are Rampant in America." And I happened to be in the PRI conference the day the weekend this came off, and the title of the article was pretty strong. Why I would have labeled it different. I would say, why not USG investors are walking the talk outside the US? And there's three reasons why the US are not. And if you read the article in Economist, they do walk through this, but it's a little bit more bombastic. So anyways, my message is that it is important to be there, engage with some of these institutions. So I'm myself, Laura Starks, and a few Caroline Flammer. We're now part of the academic network conference and the committee that is trying to bridge these conversations between industry and practice. So I think it's very important to bring this healthy dose of skepticism and dissecting, which signatories might be doing or not. And this shakeout from greenwashing and hype is a good thing, that it will clarify who's really doing ESG and equipping investors with a toolkit to succeed, and also professors and students like all of us as we learn more about this. There are many other studies around this. I will just highlight a few, two studies, contemporaneous studies in the PI documenting the same thing. Kim and Yoon just has a more limited sample just for the US equity mutual funds. They also document this disconnect. Liang, Sun and Teo for hedge funds. They also document that hedge funds may be overclaiming. But there's some success in Dimson, Caracas, and Lee with the coordinating engagement, something we did not look in our study, although those are, some of one of the biggest thing, coordinating engagement is the Climate Disclosure Project, which is the next study I'll talk about briefly. And then Dick Colley, Frank Go and Lynch, to my colleagues here in accounting at Darden, they have this, article in Management Science voting on shareholder proposals, that there is some alignment between the PI signatories and their voting. So there might be some disconnect on the ESG incorporation in the portfolio. There might be more connect on the engagement. And this is an evolving space. And this might, as these things work out from 2017, the end of our study to now, there might have been already some evolution on this. There are other papers on greenwashing, impact washing, I list here, not just by mutual funds, also by banks. We can talk about that later. And then greenwashing by corporation. I would highlight the paper by my moderator, Janet Gao here, with Ranju Shin and Qiping Xu on sustainability or greenwashing evidence from asset market. It's a very interesting study of how publicly listed entities may be divesting to privately held corporations, because this more increased transparency that ESG and other concerns are bringing to publicly listed entities may be pushing these assets out. And then our next webinar, our Jess Cornargia, I think, is also talking about ratings management, and so lots of interesting work also on conflicts in ESG rating agencies. So as a response to this, there's been, as I said, a push for more standards. So the CFI has come out with standards for their members, the voluntary standards, for example. But there's also been regulation at the EU level with Sustainable Finance Disclosure Regulation, SFDR, for the investment managers. For the corporations, they're called Corporate Sustainable Directive, CSRD. And then the EU taxonomy, which I'll talk about briefly in the end, which is designating activities that are green or not. In the US, you also have an updating, there's been more enforcement, as I showed you, on ESG. There's a task force And there was also an update of the 20-year-old names rule that you shouldn't overclaim if you have used the word sustainable or ESG in your fund, etc. You have to show that the investments are aligned with that. This is from a few days ago at Morningstar in the webinar. There's a lot happening here in terms of, it could be disclosure, could be portfolio requirements, could be global labels, could be naming rules, etc. And it is not just happening in the EU and the US. The EU is probably the strongest. And for example, SFDR I mentioned before came into force in 2021. And fund managers are required to disclose more information, and they get kind of classified into Article 6, who don't integrate ESG, to Article 8 that promote ESG, and Article 9 that are targeting ESG as an objective. And there's been a lot of readjustment of money, and reclassification also of funds from 8 to 9, etc. So there's some working papers on this. I highly recommend taking a look at this because there's been this wave of reclassification, but this is very recent work and still very much active. So let me talk maybe in the last few minutes here about the second study, which is more specifically focused on climate change. And it is, again, with co-authors here at Darden and Philip Kruger at Geneva. And this is much more work in progress. So this is not a peer review publication. It is more, a work in progress. So as I mentioned, the start of with COP28, there's this legacy of, the US and the industrial nations be responsible for the accumulation of carbon emissions. And it is scientific consensus around the need to reduce those emissions such that we meet the Paris Agreement goal of staying below 1.5 degrees centigrade. A classic example of externality. The first best solution here would be a global government tax, but coordination is difficult to achieve on this. So Tirol and Lasse Pedersen have papers around this. So that there's been some pressure on the industry. Okay, so why is this? Even the US goals and more importantly, the European goals to get to net zero, China's goals, which is, China is now 2x the carbon emissions of the US. They're very hard to achieve, and that leaves us with that, that emissions gap that I mentioned at the beginning of the talk, that government action is unlikely to fully deliver on those promises, but also even those promises would not leave us close to the 1.5 that we would need to do. So the idea is to leverage, therefore, the private sector and investor initiatives like the CDP and climate action. So what is CDP? Climate Disclosure Project. One of the initiatives from the PI was to launch this initiative, together with other partners, to get questionnaires to companies to start reporting their carbon, greenhouse gas emissions. Then also have more information around targets, reduction of their emissions, and pathways. And then the climate, with that list of, you can learn that emissions are fairly concentrated. Then there was an initiative after the Paris Accord to engage with those companies, and that's called Climate Action 100, the top 100 companies, now 100 plus. And the theory behind this is this idea of investor coalitions sort of substituting for a central planner. Now, there's some challenges, and I recommend reading the theory around that, but that would be ultimately the goal, to have coordinated actions on this. So as you think about the problem, you guys can see that that chart there, the emissions of just the industrial usage, it's more like 40 to 50 gigatons. Some emissions are more from forestry and agriculture. They're not outside the reach of most investors. But what is interesting is the emissions that come from companies that are listed in public markets, they only represent in aggregate 10 gigatons of the 50 gigatons per year. It is true that they're fairly concentrated in three material sectors: oil and gas, utilities, metals or materials. But even ExxonMobil, like a large oil and gas, is only a sliver. It's less. It's like 0.3 gigatons or so per year, or RWE, a large German utility company, or the largest steel company like ArcelorMittal, they're very small. So this is something to be aware, that all these efforts by institutional investors in public equities may only address like a fifth of the total, problem. And if so, if they're trying to do this, how are they going to achieve this decarbonization of their portfolios? Is it by exiting, just tilting away from the large emitters, or is it by voicing and engaging with those brown companies to become less brown over time? And finally, are they actually helping the transition beyond just this emissions? So this is what we wanted to do. Again, a very thriving area of research on this. On climate finance, several papers by Bolton Karperschik and Taylor, etc. I will just then walk straight to the mention the initiatives from 2005 onwards. We have data on the CDP initiative, and from post-Paris we have data on the Climate Action 100. We tend to focus more on what's called direct emissions, Scope 1 emissions, but we also conducted some tests with Scope 2 and 3. And we combine the data of the signatories, like have they joined or not these coalitions, with the same portfolio data that I showed you in the previous study, the FactSet institutional holdings. But instead of looking at ESG scores, here we're looking at corporate level emissions, so that we get a carbon footprint or a carbon metric for an investor's portfolio. We have more tests around targets and green revenues and patents, but I may not be able to do that. So the first thing I wanted you to take out is this picture of, like, if let's say BlackRock owns 1% of Saudi Aramco, then we portion 1% of its emissions to BlackRock, so as its carbon footprint from that investment. But 90% of the Saudi Aramco might still be owned by the Saudi government, or PetroChina. There still might be a large part held by the Chinese government, or Petrobras in Brazil, etc. So there's a lot of companies that are still closely held, though publicly listed. So if you look at if you take the total emissions from those companies, we are somewhere between 10 gigatons at the beginning of our sample to the end. This is the companies that get covered by S&P Trucost, the data provider. So it is bigger than the Economist numbers of 10. It's more like 15 gigatons by our measure. But if you look at the institutional portfolios in the aggregate, they only hold about 3 gigatons or so of the total. And that is because the more polluting companies are still closely held, because they might still be state-owned, or maybe have some legacy state ownership or family ownership, concentrated ownership. There's another part that is floated but is not held by institutional investors. So it's interesting because total emissions, these are just the industrial emissions, we leave out agriculture and forestry. It is growing from 30 to 37 gigatons on the left chart, but in institutional financed emissions or institutional portfolio carbon footprints are pretty flat. And that is very interesting, because institutional holdings on the right, you can see that institutional holdings have grown from 43 to 53% of market cap. So this already tells us that institutions must be decarbonizing relatively to other investors, right? To retail investors or to controlling block holders. Or, as Janet and other works suggest, maybe it's also, there's another phenomenon between publicly held entities to privately held, the chunk that is not in public markets. This is also true if you look at the more widely held stocks, the large cap MSCI equity stocks. There it's already flat. Like those companies, that the large companies are already flat in emissions. But again, if you work through back of the envelope, given the growth of institutional holdings, you would not expect that institutional holding carbon footprint would have shrunk over the period. So then the next question is, what about those committed institutions that join CDP and then later climate action, or those that do not join, the orange versus the blue? And these are the numbers in those, now, for example, CDP signatories represent a majority of the AUM. We do is we take that footprint measure I just mentioned. So if you own 1% of the stock, you have 1% of its emissions. If you look at the top right box there, we also look at other measures like intensity measures, etc., by unit of output, etc. But we focus more on the aggregate emissions. And then what you see is that there's decarbonization by blue and orange, but everything is decarbonizing. Even the MSCI equity is decarbonizing, as I was suggesting. So the question is, who's decarbonizing faster? So just to go straight to the point, what we then partition, like differently from the first study, is we find that the entities that are headquartered in countries that have carbon pricing schemes are starting to decarbonize faster. And who are those? Mostly the EU, right? Investors that are based out of the EU. The EU has the emission trading scheme. Later, Japan introduces one in 2012, and Korea, etc. China is just about to introduce it this last 2 years, but that's outside of our study. So we look at those that are in those areas versus those that are not. And then you find that the left-hand side being what is the decarbonization rate, the change in your carbon emission metric year to year. We find the coefficient of the CDP, meaning a flag, whether you're CDP signatory or not, is -3, meaning you're decarbonizing 3% faster than the other, relative to the other investors. And to get to 20, if you go all the way back to the goals here, to get to here, you need to be decarbonizing at 7 to 8% per year. It gets harder and harder every year. If you delay, then it has to be 9% next year. If you delay, it's 10% next year, etc. If you delay it till the end of the century, then you have to decarbonize 100% at the last year. So this 3% is a relatively economically important number. And then finally, how do you decarbonize? Are you decarbonizing by reweighting, meaning you are moving your weights from brown to green, or are you engaging with the brown companies and staying investing with the brown companies to help them transition? So on that, we find mostly the left. We find mostly it's greening your portfolio, and that is by looking at the delta, the changes in the weights versus the changes in emissions, and seeing that most of the action seems to be on the changes in the portfolio weights, not in the changes in the corporate emissions. And finally, that part on adoptions of I showed you before of renewable energy, electrical vehicles, etc. We did have some results there, but we mostly find some tilting, not some engagement on companies to develop new technologies, green patents, or green revenues. Again, this is work in progress, and the main message here is you're mostly greening the portfolio, not helping green the planet. And it sort of raises the concern that, yeah, you could not be greenwashing because you're greening your portfolio. That's what you're trying to achieve, but you may not be addressing that sustainable development goal, the climate action. Lots of work on this, on tilting in and tilting away, on what effect would this have, the fact that you're tilting away with this through a cost of capital, raise the cost to the brown companies. Will the brown companies transition, or would it make it hard for the brown companies to transition? Lots of other work also in other asset classes. So to conclude, I wanted to give you two messages. One was beware of greenwashing. And now I'm think we all are responsible for academics and practitioners to examine these issues, and these issues could be resolved by some regulation, could also be addressed by our pressure. But even if you do walk the ESG talk and you green your portfolio, as I showed you in the second study, we should all not really care whether you do ESG or not. It's whether you actually achieve the ESG goal or not. And that is much harder to assess. Many other topics are out there. The politicization, the anti-ESG backlash on this, many other dimensions beyond climate change on E are diversity. The number of studies are coming out on that. The regulations I mentioned, are they being effective or not? And will this, focus on, for example, climate lead to social costs, or do we have a problem of just transition? I will just close with one advertisement, which is, as I mentioned, we're now involved with the PI academic network. So June and I were, for example, at the last event in Tokyo around the PI in person. You can join some events online as well. There's a webinar series, and our next one is Itai Goldstein in January. And you can also join us next year where the conference will be in Toronto. So with those, thank you for allowing me to do some of this advertising. I'm very much looking forward to the Q&A discussion with Janet. And I also look forward to many other talks in this series. So I'll stop sharing and turn it back to Janet. Thank you.
Thank you so much, Pedro. You ended just on time. And there are already lots of questions queuing up in the Q&A session. And so I'm going to ask some of these questions. Let me start with the questions in the pre-lecture poll. And because there are some questions with commonality. So one of the questions I think is kind of repeated is the effects of greenwashing on the anti-ESG political backlash. And relatedly, one of the audience members asked, do you see greenwashing becoming more popular in the US in the near future? Do you see this as a hindrance to the prevalence of ESG investing in the US, or would it help push the ESG initiatives in the regions where it is welcomed or politicized? So I think these are related questions about kind of the division in the view towards ESG, especially in the US.
Yeah, I think those are great questions. I don't think greenwashing helps promote ESG investing. It does undermine some trust on the effectiveness of ESG investing. It is used sometimes as ESG not being sincere and fuels that anti-ESG backlash you mentioned. It also, but on the positive side, it has led to some regulatory scrutiny, and this may be a good time to create the standards, rules, and checks. Now, I'm not apologist of every type of regulation, rule, and check, but this is like a good place to do so. And since it's still unfolding, I think in the long run, maybe this standards, rules, and checks then can actually strengthen the credibility, the effectiveness of the ESG initiative. So it's like I'm copping out, but I'm thinking it's actually, you have to be honest about greenwashing, and that and some somewhat legitimate concerns from anti-ESG backlash, such that you can actually improve this. And it is important that a lot of the that people get a choice, and then they're provided a choice. So if you are participating in a pension plan or etc., that you get polled and your preferences are reflected into your investments. That's something that in Europe that is that goes alongside with the rollout of ESG, is also that you should be asking the investors themselves if they want to tilt their investments in that direction.
And the next question, again, is common theme. It's related to the measurement. So one of the audience members asked, are the emission numbers accurate given that companies are voluntarily disclosing them? Relatedly, prior to the lecture, there was a question in the poll that if we don't rely on ESG metrics, then how else can we measure the real effect of ESG investing or the effectiveness of this strategy?
Yeah. Yeah, I think it is promising to have, the development of this ESG ratings and all, but they're provided by various agencies. They do vary in their criteria, and there's some inconsistency or confusion that might come from that. May make it hard to compare companies. But I think this is actually a natural market development. And you don't want also all equity analysts to think the same way, right? You want differing views on issues. And so I think it's more what you said, the accuracy, some concerns around accuracy, completeness, timeliness of the data, and companies may be, selectively disclosing. So there's this efforts to standardize the reporting. Those would be important. I think you did mention also that ultimately, and I think there are some products that try to give you SDG alignment. They're very hard to measure, like how your investments are actually helping address climate change, nutrition, gender parity, social justice, etc. So if you look at 17 Sustainable Development Goals, those are harder to measure. Some of those things are not even right now measurable, let's say. But I think that is, I think the ultimate goal of initiatives like the PRI and so forth is that we get to a place where we have the ability to, the data to get to all these questions. I think there are other concerns, not just beyond the ratings and the measurement. There are concerns with proxy advisors, that a lot of investors may be outsourcing their responsibilities here in terms of their engagement and their voting. There's some concerns that a lot of, I think in my mind, a lot of times this products get sold, you do well, and do good, and there's no, that's not what finance theory would suggest, which is that you should expect lower returns for ESG products, so that you can actually achieve those sustainable ESG goals. And it's not clear to the investors how much they're willing to sacrifice in terms of returns, because during the time period where we've observed this, there's been a rush of money into the space, and so green strategies were doing really well up till a year ago or so, and now they're kind of unraveling. So we really need to clarify also not just how to measure and quality and consistency of measurement, what performance expectations should be there. And as I mentioned, the regulatory environment is still evolving, so it is still hard, I think, for many investors to navigate this uncertainty or in the regulatory space. So there's more issues than just measurement issues. But I think it's good that we study all of them to bring more light into them.
Okay, thank you. So there are two new questions that pop up on the screen, and I think they're sort of related as well. One is about would the inclusion of Scope 3 emission address the problem that listed companies only account for a fifth of the global CO2 emission? And the second one is perhaps more a tougher question. Is it appropriate to penalize investors for greenwashing?
Mm-hmm. The first question, I think it is a great question. I think we did in a study only look at Scope 1 emissions, direct emissions. That's also what most investors report. If you look into the Norwegian Sovereign Wealth Fund, like when they report GPIF's carbon footprint, etc. But the majority, like of the oil and gas emissions, come later when you burn the oil and the gas, right? That comes from downstream, or for example, from my iPhone, for example, majority of the emissions come also, a large part of it comes upstream when Honhai or Foxconn does it. So the SEC was trying to attempt to get disclosure by corporations on Scope 3. It's not making progress of that. That was actually literally the one that received the most comment letters, the proposal that's ever received more comment letters, because people are very there's a lot of debate about how you measure it. Once you do, let's say you are able to do it, and we did it like, you shouldn't just add 1 + 2 + 3, 1 being direct, 2 being purchase energy and heating, etc., and 3 being upstream, downstream, because there's some duplication. So for example, as I said, if you have, Apple and the supply is Honhai or Foxconn as we know it, then we might be duplicating it. And the purchase power of Apple is also duplicative. The utility is also listed. So you have to undo some of that duplication. And it is possible with input-output matrices and so forth to somewhat undo that. But then Janet gets into Janet's work, which is, what if those emissions are outside public equities? And that is, for example, if Honhai uses a supplier in Chengdu and another Chinese supplier that is not publicly listed. So it is, then it's up to, I think investors may expect Apple to do that work, to go upstream and downstream to figure out all that so that they can get reliable data. But I think that is a challenging thing, because I agree, the 10 gigatons, that high number, that small number I showed of the 50 gigatons, is because the majority of the emissions might come downstream from our consumption, or may come upstream from things that may not be produced by these entities, the inputs and that go into this. Remind me the second question, Janet. Sorry.
Yeah, is it appropriate to penalize investors for greenwashing? And I think the question is also about whether should you penalize firms for greenwashing as well?
I think we're at the early stages, so the PI might be a good example. And they decided not to penalize until a couple of years ago, and then they have finally kicked out some members. Their interpretation, now I'm not going to put words in their mouth, and I don't mean to do that, but it's more like that they want to bring this tent, a lot of people into the tent, so that we start getting the conversations going, and processes and standards and measurement and quality, consistency, etc., into the process, and then we can kind of penalize, let's say, or give grades or whatnot. But I think it's still good to bring a lot of companies and investors in the early stages of this, such that this is truly a productive effort. If we start penalizing immediately, then we may not have given time and effort for the deployment of ESG. So maybe for people who are more skeptical, they might say, well, Pedro, it's already been 10, 15 years, so it might be time by now. Whereas it really depends what issue we're talking about. Like, for example, biodiversity, we're at the very early innings of that. But for maybe climate change, we have a better understanding of greenwashing in that context.
Yeah, I think also one of the challenges is the greenwashing by definition is very vague, right? It's hard to capture the true intention. So there are several challenges that comes with it. First of all, for example, how do you measure clearly the extent of greenwashing, and how do you get to the intent rather than just the action of it?
Yeah, and might be even hard to separate greenwashing from cheap talk, which is not ill-intentioned talk, but versus the ill intent, as you said, Janet. I agree with you.
Yeah. So I think we're close to the end of the session, and I'll hand it back to June.
All right. Thanks so much, Pedro. Thank you, Janet. I think this is a well-needed discussion, and we're only at the beginning of it, right? So Pedro already highlighted, maybe many of the investors are really picking the green firms and leaving out the brown firms, but to what extent you can make the green firm much greener while leave the brown firms even browner because more brown because they don't have the resources? Is that the right direction we're heading for? Or to what extent the talk is aspirational that may lead the walk at some point? To how many years, how many months you should give these investors or asset owners to walk their talk? So these are probably bigger questions, and we may need a little bit more time to address these important questions. I hope today's talk will give us the better, thoughts to start the next round of discussions, or maybe in the near future we can revisit these problems either in terms of climate risk or social issues, because there's a diversity washing paper as well. So they're looking at your walk and how does that deviate from your talk. So these are important topics. In the last minute, I'm going to feature the next public lecture. It is going to be the governance of certification agent. And here, Jess is going to touch on the ESG rating agencies and the divergence of their ratings. QR code is here. Thank you again for supporting the Kelley ECGI. Thank you for attending our lectures. Thank you, Pedro, and thank you, Janet.
Thanks very much. I appreciate it.
Thank you. The recording will be posted and slides. Thank you. Bye. Okay.